What is the best way to pay yourself from your construction company? Follow my video for more. If you haven't yet, click the bell and subscribe to be notified every time we produce our best pieces of content. Congratulations, you've built your construction business to be the most profitable it can be. That's awesome. But now you want to take all of them profits that you've earned and you've put in blood, sweat, tears, determination to get it there. You don't want to be paying more tax than you need to in taking money out of the company that you've worked so hard for. So follow my video and we'll explain all the key considerations that you, the business owner, needs to deal with when taking money out of your construction business. Point number one, let's get rid of a myth straight away. If you run in a construction business, you cannot declare yourself as a subcontractor and as a sole trader to take money out of your business. It's out and out wrong. In layman's terms, if you're going to be self-employed, it means you're separate. So if you own and run a company, you cannot be separate from your business. It's impossible. So when you're looking at taking money out of your business, do not ever declare yourself as being self-employed under the CIS scheme in taking money out of your business. You could get in massive problems and owe a bucket load of tax if you do this strategy. A good starting point for your construction business is look at taking a salary out of your business. So you'd want to either take up to the national insurance or tax limit a salary for you for the work that you're conducting within your business. This is really cool because the company gets corporation tax relief on this salary and you can get most of this salary payment tax-free. Win, win, win. Please note, if you don't take it, it doesn't matter. Make sure that you are declaring a salary even if you've had a poor year, because if you don't use that relief, you lose it. Bear that in mind, even if you've had a one-off year where you've had a loss-making year. Number two is dividends. So are you taking the right amount of dividends out of your construction company? Now be careful because rates change a lot. Are you taking up to the required limits where you're paying as least amount of tax as possible? Now the limits to bear in mind when you're looking at tax planning is your tax-free personal allowance, up to 50,000, up to 100,000 or 125,000 or over. So depending on what category you fit in, that will be important on what level of dividends you declare. Now be aware, if there's no profit or you've got a negative balance sheet, you cannot take a dividend. These are illegal, don't do it. This may be a little bit tongue-in-cheek and this may be a little bit patronising, but how many vans have you seen with construction businesses that have got receipts littered all over the floor? They can be everywhere. And it's quite easy for you to pay for these expenses on your personal debit card or cash that you've got out of your own pocket. But are you making sure you're claiming all of these, or are they disappearing into a black hole? Now, let me put some perspective on this. If you're a high rate taxpayer, you are going to be losing 50% in tax. How do you work that out? 19% corporation tax you are going to lose unless you've got the receipt. Now, if you're paying for this out your own personal money and you're a high rate taxpayer, you're going to be paying 32% dividend tax on this. That's massive. So make sure you are not burning money for your construction company by not claiming all of the expenses that you're paying for personally. Don't fall into that trap. Sometimes construction businesses are cyclical. It's the way of the market. And also there were times, especially when you started off with, you may invest money in the company to get it going. Now this money's invested into an account called the director's loan account. Now if you have a credit balance on this, which means the company owes you, you can charge interest to your company. Now I think this is massively attractive because you can get corporation tax relief on that interest charge. Amazing. And you are allowed to earn interest per year without paying tax. But after that, all you do is pay income tax on that interest. You don't pay any dividend tax as well. Tax planning 101 tip will be, if you have a credit balance on your director's loan account, which means they owe you, make sure you are charging interest on this balance. It's a tax relief that a lot of people do miss. Make sure you're not one of them. Pensions can be really, really beneficial. The downside of pensions is you are locking up the money for a fixed period. Now, you are able to get the money when you're 55, so one consideration is, where are you in your business adventure? You may be 25, you may be 35. The closer you are to 55, the easier it is to take it out. Again, I love pensions. Don't lock up too much money in a pension because you want to make sure your business is solvent and you've got liquidity for cash flow. If you have, then you get over a 50% saving on money that you invest into a pension. Now that's massive. And what's even better than that, you're able to use that tax relief to build your wealth further. And when you come to draw on your pension, which normally people do when they're retired, you'll be able to pay a chunk of this at basic rate band. Now that's humongous. Instead of paying the 50% that you're paying now with salary and dividends, you could potentially be taxed on that at 20%. And also with pensions, when you first draw it down, you have the option to take 25% tax free. They're not all bad, it's how well they're managed. But are you making the best use of pensions within your construction industry today? Now, when you're taking money out of your business, be aware of when you're taking it out, what effects does this have on corporation tax? So let's run through them. Salaries are deductible for corporation tax. It means your tax is calculated afterwards. Dividends are taken after corporation tax. Bear in mind that the dividend tax that you're paying, you would need to add the corporation tax rate to work out what your effective rate is. Interest that you charge on director's loan account is a corporation tax deduction, means you're allowed to take that off your profit before corporation tax, and you pay tax on this on your self-assessment. So when you're looking at ways of extracting money out of the business, look at what the effective rate is. Is there a corporation tax charge on it? And also what you're paying personally. Add these together, these are the two figures to compare with. If this doesn't make sense, or you find this a little bit daunting or don't understand it, you should be sitting down with your accountant and your advisor. They should be looking at all the options and all the reliefs to make sure you're saving the most amount of tax every single year. Now be mindful, tax rates change. And we've seen in the era in 2022 with Liz Truss, tax can go down and then up again, and it was all a bit of a pantomime. But regardless of that, tax changes all the time. So make sure you're up to date with the reliefs, up to date with the tax rates, so you are in line with the right advice. And you're not taking advice that you should have done 4 years ago, you're doing what is right now. Now, some of this can be quite daunting if you're not used to financial affairs yourself and you don't find it comfortable. So sit down with your accountant, or if you haven't got that opportunity, book a discovery call with me below. Let's run through what you need in layman's terms. You don't want to be tied up with financial jargon. You just want to know you're making the best decisions for you. I promise on this call, I'll do my best to help you, and there'll be no pushy sales pitch.